Even with the benefit of hindsight, I'd say the RBA have probably got this cycle exactly right. So let's zoom out a little bit into thinking through what are the kinds of reasons why the unemployment rate rose this month. So of all the, unemployment rate rising is never a good thing, but of all the ways it can rise, this is perhaps the best of them. So what everybody would like, including the RBA, would be that some of the tightness of the labour market goes out, not by people losing their jobs, but by more people coming into the labour market to ease those labour shortages that businesses are talking about. And that's exactly the form of the increase in the unemployment rate that we got. So there are still people who are finding jobs every month, even including this month. The number of people employed did rise by 2,000 people. But there were far more people who chose to enter the labour force because conditions are particularly good at the moment. Now that will help to bring inflation down slowly, but it's not as if this unemployment rate is above where the RBA thinks it needs to be for inflation to hit the target. The RBA's forecast was that the unemployment rate would rise to 4.3%. That's exactly what we got today.
The monthly job series from the ABS is notoriously volatile. Can you pick a trend from here? Do you expect the unemployment rate to go up, or is it too early to tell?
The unemployment rate has been very slowly trending up. So we're talking about a rate of about 0.2 to 0.3% per year. But we shouldn't expect that increase is going to continue, because all of the things that indicate how many people are likely to be hired in the future are going up. So surveys of vacancies by firms, surveys of how hard it is for them to find labour for jobs that they've posted, those are also indicating that there's more demand for labour than there was 3 to 6 months ago. And at the same time, the growth in the population in Australia is slowing down as well. So we're most likely to find ourselves in a scenario of balance, not over full employment, but not under full employment, and the unemployment rate remaining at about 4.25% as it is today.
So Andrew, the unemployment rate is about where the RBA thinks it will be. When it comes to inflation, Michelle Bullock essentially dismissed the monthly inflation read that markets were hanging on and really wants to see what the quarterly inflation data will bring.
That's right. So the monthly inflation indicator is sort of like a building block to the quarterly inflation data that samples every price in the economy. But on the quarterly inflation data, by the time that we receive 3 monthlies, we've seen all sectors of the economy. So that's what the RBA mean when they say that the monthly inflation picture is an incomplete read of price pressures for the whole economy. Now, as long as we do see inflation continuing to decline when we receive that quarterly inflation data, and that's probably trimmed mean inflation of around 2.75%, then the RBA will be willing to cut again in their August meeting.
And markets have raised their bets to around 86% that we will see a cut at the August meeting, but they were about 97% that we would see a July cut.
Yeah, I would say with market pricing, you can mostly trust it, but you may also want to verify. Now, the market, more often than not, is correct on what the RBA is likely to do. But the RBA themselves cannot simply follow the advice of market pricing. Otherwise, you'd have to ask the question, well, why do we need so much talent in the RBA at all if we can just rely on the talent of financial markets? I think it is appropriate that the RBA doesn't always do what the market is pricing, because there's room for disagreement between reasonable people. The market is a reasonable person, the RBA is a reasonable person as an institution, and they may sometimes see things differently. Now, I would say in this instance, this was a fault of the market rather than a fault of the RBA.
Well, another central bank that's unlikely to lower interest rates in July, despite a barrage of criticism from the president, is the US Federal Reserve. Donald Trump has really ramped up his attacks on Jay Powell.
Now, we have seen this before with other presidents and other heads of the central bank, but not in recent history, and usually it doesn't play out in public. But to take an example, Arthur Burns, in his private diaries, he released that he felt under a lot of pressure from the president of the day, and there was animosity between those two. Central bank independence is absolutely everything, but the important thing to remember in this instance is it doesn't matter so much if there is pressure coming from the president to the central bank. What matters is whether the central bank caves to that pressure. Now, what we've seen in financial markets so far is that we see a cut at the next meeting as very unlikely, which is a sign that financial markets still believe in central bank independence, and that is the most important thing.
Andrew Lilley, thank you so much.
Thank you, Alicia.